Good afternoon. Welcome to today's webinar, Understanding the OBBB, Essential Tax Strategies for Construction Professionals. Today's event will provide you with an overview of the One Big Beautiful Bill legislation and its broad impact on the construction industry. And we want you to know the construction solution specialists at HBK are available to you beyond today's 1-hour webinar. We'll have time today for Q&A at the end of today's session, but if we don't answer your question, or if you'd like us to take a deeper, more personalized dive into the information, please get in touch with us. Our presenter's contact info is in the bio section on your screen. To submit your questions, use the Q&A box in the lower left corner of your screen. Today's event will be recorded. We'll post the recording on HBK's YouTube channel, and a copy of the recording will be emailed to you. Please take a moment to follow our LinkedIn page by clicking on the links below. There will be updates and more webinars in the coming weeks and months, more valuable information that could benefit you in the new tax environment. We don't want you to miss a single one. Today's presenters are Mike Kapics, Principal and National Director of Construction Solutions, and Nick Demetrios, Principal and a member of the Tax Advisory Group. And now I will turn things over to Mike and Nick to get us started.
Thanks, Wayne. Appreciate that. And welcome, everybody. Thanks for joining us today. Hopefully, today we're going to give you some great tips and pointers that have come out of this One Big Beautiful Bill, and specifically how they relate to the construction industry. And, you know, when we do these types of presentations, it's obviously difficult to get very specific for your individual situation, but I hope that we'll do a good job giving you an overlay of the new stuff that's out there, and giving you some great ideas, from talking a little bit more in detail afterwards about your specific situation. I think that, today we've got me and Nick presenting. Just to give you a little idea, Nick is going to be the smart guy that's going to give you all of the technical aspects of these rules. If you have anything difficult, he's the one you're going to want to ask with those questions. My skill set mostly lies in getting it told to me in regular words, and hopefully giving you a little bit of insight into how that will affect your construction company. So hopefully you're one of two kinds of people: the one that likes to hear all the nitty gritty details, and one that just wants to hear the overview and how it's going to affect them. And one way or another, I think we'll get our message across to you today. So, this bill overall has a lot of impact on the tax end of things. And, again, Nick is going to go through some of those details, and a lot of this is extenders, really, and bringing back some common sense to how a couple of these tax credits and deductions worked. But very important changes that could drastically won't impact everyone on the call, but could very much impact you in a big way. And then I think near the end, we're going to talk about what I'm the most excited about in this bill, which is oddly a tax deduction that's going to be available to manufacturing companies, which you're going to think is real weird in hearing that if this is the first time you've thought about it, but I think I'll explain how that's really going to help you guys at the end of the day. So I'll go ahead and turn it over to Nick and let him start working through, and come back in when I can give some real world explanations.
All right. Thanks, Mike. Thanks, Wayne. Navigating the new tax landscape is what we're going to do today, and we're going to jump right into this regarding bonus depreciation. We've been dealing with some form of bonus depreciation for about 24 years now. I think there was only a couple of years in that time span where bonus depreciation did go away. And it has ranged anywhere from 30% to 100% over that period of time. Now, under the Tax Cuts and Jobs Act back in 2017, first year implemented 2018, we had 100% bonus depreciation, but it was phasing down to 40% with the 2005 tax year, 20% for 2026, and then zero after that. So this is basically reinstating bonus depreciation at 100%, starting at inauguration day for assets placed in services of January 19th, 2025. This would apply to assets that are under 20 years of maker's depreciable lives. So all your equipment will qualify for this in most cases. In addition, there's new types of property that we'll get into later called qualified production property, which is what Mike had mentioned regarding the manufacturing industry, as well as qualified improvement property, which is internal improvements to your existing buildings. And it's something that we were counting on happening, that we wanted to see it placed in legislation really since over the last 3 years. So this is a good incentive to purchase equipment, and it's back and it's permanent, which is crazy because they would actually have to change this by statute in order to get rid of 100% bonus depreciation going forward. It applies to new and used property, the qualified production property, and qualified improvement property. And we'll get into more details on all of those. So I didn't know, Mike, if there's anything you wanted to mention specifically in regard to the construction industry for this. But that's where we're at.
The easy answer here is you're pretty much free to go buy any equipment you want, and we're going to most likely be able to take a tax deduction in full for that. With that and the expansion to the rules of Section 179 that I think is the next slide, you'll see that this basically just made a process that has always been around. It kind of got tightened up on us a little bit, and there were certain situations where if you acquired too much equipment in a year, or if you needed to utilize bonus depreciation instead of Section 179, if you were maybe in a loss situation, it sort of tied your hands a little more if these changes didn't get put into place. So, we kind of look at this as just making things a little bit easier on people to go make investments on some of the equipment. I know some of my clients, they're buying equipment sometimes, and they're not, they just sort of assume that this tax deduction is going to be there. And there are some certain cases where it can get a little hairy on them. This offers a lot more freedom from that end of things.
Yeah. Definitely does, as well as this next one, which is the increase in the 179 expensing. I think what's important here is this phase out of purchase limitations all the way up to $4 million. Equipment's expensive. Expanding is expensive. It's not out of the realm of possibilities to spend more than or $4 million or more, limiting your expensing. 179 expensing is not as critical when we have 100% bonus depreciation. 179 can only take you to a zero taxable income. You can't create a loss with 179. But in situations where I can think of a couple situations where it makes sense to use 179. One is for if you're in a state that has not decoupled from 179. You may actually, if you're in a high tax state, you may be more beneficial taking 179 than bonus because you won't have to add back the expense for tax purposes. The other is in regards to using the 179 in situations where bonus doesn't apply. 179 has some carve outs for HVAC and roofs and things like that bonus doesn't have. Which allows for immediate expensing in those situations. So a mix of bonus and 179 a lot of times makes sense. But again, not as critical that we have the 100% bonus depreciation. But definitely it's worthwhile to have this. Makes a lot of sense in many situations. Another thing I could think of is if you're a C corporation, or you're looking at potentially creating NOLs for yourself, having carryovers of 179 expense aren't limited to the NOL limitations of 80%. So if we're having losses in excess of income, it may make sense from a planning standpoint to spread that over a couple of years and avoid being an NOL. So like I said, a mix of both. We'll figure it out for you. But they're both there, and you got a $2.5 million deduction handy for you, and your purchase limitation is $4 million. So that's really a nice, simple, easy one to throw at you. Again, has been around forever, but continue. I think when we first started this back in the early 2000s, 179 expense was 10,000 or 25,000, something like that. Now it's 2.5 million. So it's exceedingly more, but it's super helpful in your equipment purchasing situations. All right. We'll talk a little bit about R&D. I know that's not in totally relevant to the construction industry, but the thing that was creating a lot of problems for manufacturers, computer companies, tech companies, was the fact that under the Tax Cuts and Jobs Act, you had to capitalize your research and development costs over 5 years for domestic costs and 15 years for foreign research and development. This has restored, and this is a bipartisan issue. This has restored the immediate expensing of those items, those expenses, starting in 2025 and 2026. If you qualify as a small taxpayer, you can deduct them retroactively, and there's some methods that we can do that by filing amended returns and some elections, which is actually on the next slide regarding that. But this is the situation with this is it is going to be a cash flow boon to manufacturers and tech companies that have paid a bunch of taxes on phantom income over the past 3 years. And what they do with that money, whether they use it for expansion on some of these additional incentives that have come through the act, we'll talk about in a little bit. But research and development costs now can be fully expensed. And it's something that was creating a lot of problems and a lot of cash flow situations for our manufacturers. It was very counterintuitive to the R&D credit. And we won't get into the intricacies of that, but this fixes that situation. And again, had bipartisan support and makes all the sense of the world to have this changed.
And for those of you, that have a construction company that is taking advantage of the R&D credit, this can be a big win for you. Again, it's probably a smaller percentage of you that are actually doing it, but it can be a huge win for you. So this is one of those ones we kind of all discussed, rights or wrong. Right? It sort of made no sense the way they were handling this. And we kind of kept waiting and waiting and waiting. They're going to fix it. They're going to fix it. They're going to fix it. And they just never did. So unfortunately, we had to deal with it for a couple of years. And like Nick said, this could be a nice cash flow pickup for anybody that was utilizing these credits. And you're offered a couple of different ways to potentially go back and take these deductions. So again, a very specific analysis for your company is something you want to have a little bit further discussion, most likely, about to see how that's going to work.
Yeah, if you do have capitalized R&D costs on your books, we should look at the best way to take advantage of them. If you're considered a small business, meaning you have under $31 million of a 3-year average revenue over the past couple of years, we can go back, file amended returns. We could take some of the deductions in 2025, some of the deductions in 2026, all of the deductions in 2025. So this is something that we can look at and plan for right now. Moving on to the qualified business income deduction. We've had this now since 2017. Since the 2018 tax year. Tax Cuts and Jobs Act was passed in 2017. But this is permanent again and takes the 20% deduction into the tax code forever on qualified business income, which would apply to the construction industry. There was proposals in the House to actually raise that to 23%. It did not happen. There is some extended phase-in ranges for small business or for service businesses. But again, that's not something that we have to be concerned with on the construction side of things, unless you're a pure consultant. You could end up having some service trader businesses that have additional phase-ins, but there's a small minimum deduction now of $400 if you have at least $1,000 of QBI. I have no idea why they put that in there. It's one of those things, you read it and you think that this should be something more significant, but it's not. But it is in there. But keep in mind, we take advantage of qualified business income deductions all the time because it's cutting your marginal tax rate from 37% to 29.6%. And if you are a C corporation, you're comparing your flow-through income, looking at whether or not I should be a C corporation or whether or not I should be a flow-through entity. We only have a rate arbitrage now of 29.6% to 21%. A lot of times people think that being a C corporation is beneficial, and it can be in certain situations, but you have to always consider the double tax rules and what could potentially happen on a future sale of your business. So these permanent extensions of the 199A deduction make it a lot easier from an entity planning perspective to decide where we want to sit as either a C corp or a flow through entity, and it takes a lot of guesswork out of that situation. But this is something that is absolutely huge that they made this permanent. All right, moving on to the business interest limitation. Tax Cuts and Jobs Act created a business interest limitation of 30% of your adjusted taxable income. Adjusted taxable income was EBITDA for the most part. And then it switched 3 years ago to not allowing you to add back depreciation and amortization to come up with your 30% threshold. That is huge because we've got all these depreciation incentives in the tax code, 179, amortization of goodwill, bonus depreciation. So if you were taking those deductions, you could, in fact, if you were leveraged, be limited on your business interest deductions. Now, those carry over forever, but there are situations with leveraged businesses where this could put you in a taxable income situation, depending upon your debt situation. So the fact that it's now restored to allow you to add back depreciation, amortization, and depletion has created a much better threshold at that 30% of ATI than using 30% of the ATI without those add backs in it. So it's a lot easier to think about it being EBITDA. Makes a lot more sense from a standpoint of non-cash expenditures, limiting your interest deductions. It's great for the industries that do have debt or are considering taking on debt for expansion. So this is another positive that's out there that will mitigate taxable income, lower your tax bill. This combined, and you don't get punished for taking bonus depreciation or 179. So that's a great thing to keep in mind.
Yeah, this is another one where we feel like it kind of right and wrong. Like Nick said, as far as how that's going to affect your construction company, this limitation, but it can make planning and business decisions very difficult and very convoluted. Like Nick mentioned, we've got all these great depreciation rules. They allow us to take immediate write-offs of all the new equipment that we're going out purchasing. But when you have to couple that with the potential for those not being added back, and then all of a sudden we kind of have to come to you and say, hey, by the way, all that interest you paid, you don't get to deduct. So great, we got the deduction for the depreciation, but we got limited over here on the other end. And it never really made a lot of sense to not have that in there. So I think that if this is something that you've fallen under, at least you can know now it should not affect you. in the same way, and certainly should. For some clients, this is a huge benefit where they've been getting hit pretty hard with these limitations, and it will make a dramatic effect on their tax bill going forward.
Yeah, for sure. For sure. It was, the three big things that we had discussed is wanting to get changed in legislation, which had been talked about even through the Biden administration, was fixing the 174 R&D deduction, extending bonus depreciation. They actually had legislation drafted that died in the House or in the Senate after it had been passed by the House to fix that, and 174 and 163J, which is the interest expense deductions. So the fact that this legislation covered all those sort of big three topics, I think is very favorable for taxpayers going forward. And the fact that they made things permanent is even bigger, because they can't sunset and just go away by inaction. If someone wants to change it, it has to be changed through tax legislation and passed. And politically, that becomes a lot more difficult. I think, does it look like we have a question? Yes. Is the eligibility for property based on construction start or construction completion? Oh, okay. So you're talking about, when, if something is placed in service, if you started something, before or after the deadline, whether or not you get the 100%. You have to look at the placed in service date. For long-term production property, there are specific rules. If something's going to take more than a year for us to be able to use various types of depreciation on. If a project were to start sometimes, if it's a long-term construction project and you started before and you had things in service before that January 19th, 2025 date, you could still be limited to the old rules. I'd want to look at that in very specific fashion. I think one of the big things that we'd want to worry about is when that construction started, what particular phases of it may or may not have been in service, and whether or not the bonus depreciation will apply at either 40% or 100%. You can actually elect to stay under the old rules for the 100%. So there are timing situations in there that we would need to look at. I think it would be something that we could do offline. But looking at that question is important. That's a great question, because the time periods on long-term property, long-term construction, or self-constructed property do apply and are meaningful. Okay, moving on to this special depreciation for production property. This is what we were talking about earlier, where for manufacturers, this is huge. If you have a construction beginning on January 2019 or after and before 29, and placed in service by the end of 2030, again, these are long-term construction rules, you can take that property and depreciate it under the bonus depreciation rules. It's called qualified production property. And even though that building would be considered, 39 years of depreciation ordinarily, it can be deducted in 1 year under these rules. So if someone is building a manufacturing facility, they can take 100% deduction for the cost of that when it is placed in service. This is a major tax benefit for manufacturers. This production property, and again, there's going to have to be regulations issued on this because there are some gray areas. like if you're building production property, it has to be only the production property that is eligible for the 100% write-off. The general and administrative sections of the building don't apply. And then also there is a situation where you could have if you sell food, if you're producing the food and selling the food in the same area, like a restaurant, they carve that out as non-production property. The other thing to keep in mind here, and this is going to be problematic for a lot of manufacturers or for people in general that operate their businesses where the real estate is in one entity and the operations are in another entity, is property won't qualify if it's subject to a related party need. So if you have that, like many people do, where the real estate is in a separate entity for legal purposes, that won't qualify for production property. But again, we're going to figure out how to get around this. The property could be owned by the operating company. I'm not sure how granular they're going to get with this regarding the self-rental between maybe disregarded entities and regarded entities. So there's going to be some clarity on this. But I think the biggest thing to keep in mind is if manufacturers are looking at expanding or building new facilities, they have a huge tax benefit to take advantage of, which means they need you to help them build the building.
Right. That is, so you're probably wondering, why are we talking about a deduction that's really not going to affect your taxes, right? And that is the whole point. And this is the thing that I am by far the most excited about in this bill as it relates to construction companies. We've got some great extensions of these tax deductions, and again, they've righted some wrongs, but this is the thing that I think is going to absolutely make a giant impact on the entire industry. I guess I don't want to overstate this, but I honestly think this could set up for the best 5-year run in the construction industry in the past 50 years. If you think about what this does for a manufacturing company, you are taking, potentially the biggest investment you make, right, is your real estate, your building. You're taking that deduction that used to take them 39 years to recover and giving it to them all in 1 year. So if they build a $4 million facility, they're, even highly profitable companies are going to be able to wipe out their taxable income and help cash flow that project so much easier than they did by taking that over the next 39 years. This is one where I think you have to start acting right away. Okay. So if you're running a construction company, you're saying, how is this going to help me? We have already had manufacturers, some of our manufacturing clients, I was speaking with earlier with our manufacturing group. They're already getting phone calls from our clients saying, how do we do this? When can we start? We've wanted to build a building for 5 years and we just haven't pulled the trigger, and this is going to make us go. Right. So that's music to my ears as a person who tries to help construction companies, because you guys are going to be the ones building all these buildings. The surge in demand that I think is going to occur over the next few years, I feel like is going to be unprecedented out of one change to the tax code. There are literal strategic changes that I think you should be considering with your company. If you have done a lot of work in manufacturing in the past, and maybe it's been a little bit calm over the last couple of years, right? Maybe you did some big upgrades for some of your customers, and the last few years there just hasn't been so much. I would be nuzzling up to them as quickly as tomorrow, because they're going to be ready to do something, and you've got to be the one that they're going to call when that time comes, right? You want to be the preferred bidder, the only bidder, whatever you got to do on the short list to make sure you get these opportunities. It's a complete game changer for people who are are considering an expansion. And I really think that the more that we get ahead of this. The companies that get ahead of this and start thinking strategically about how this is going to impact their business are going to be the ones that are best suited to take advantage of this. The surge in demand is going to be incredible. I truly think the projects will probably be larger than they might have been, right? So when we're given this tax benefit, their willingness to maybe stretch their budget a little bit and maybe do bigger projects than they were even planning on, I think occurs, which is always a great thing for our industry. There's going to be a lot of speed and availability that is going to go into this, because not only, we've got a 5-year window here, right? So there's plenty of time for them to get their building. But remember, there's going to be pushes to get these things done by the end of the year. Whereas they may not have been all that worried whether that building got put in by December 31st or it was done in early January. Well, now that could be all that matters to them, right? So you're going to probably have to deal with some tight deadlines, maybe some speed issues where I believe that if you're going to be able to if you're the company that's going to be able to come and get it done, there should be a performance bonus in there for you. It's going to open up a lot of different opportunities like that, where it's going to be important for those manufacturers to get things done by a certain timeline. I think that this, on a sort of downside, this may have a bigger issue of leading to some price inflation on inputs. If it takes off like everybody seems to agree it's going to, it could affect your input pricing. So strategies around, purchasing a little bit ahead or using hedging strategies, all of the different things that you can do to help offset that horrible experience I know a lot of you went through, over the last decade, for parts of this decade, at least, with that inflation. It's also one where if you're going to have to consider expanding a division, starting a division, maybe even for this industrial manufacturing work, you don't want to be late to the party, because I think that what is going to happen is that there is currently a lot of pent-up demand. Again, I think everybody that owns a business, this has been probably the hardest couple of years, because everybody's been in limbo, right? And no one really wanted to do anything until we found out what happened with the election, and then we found out what happened with the tariffs, and then we found out what happened with the tax bill. Now that we've sort of got clarity around most of those items, I believe there's been some pent-up demand out in the market that is going to would have accelerated even without these changes. Now we're throwing gas on the fire a little bit as we make this change. So if you're going to be someone, if you decide a couple years in to start on this strategy, I'm a little nervous for that, because I think that you don't want to be late to the party on this one. There may be a lot of buildings put up in the next 5 years, and then there may not be for a couple of years after that, right? It's just going to kind of go with the flow of the economy. And if we sort of overbuild in that 5-year period, there's going to be a potential slowdown that could follow that. So just strategically, some different things that I think you need to think about when you're trying to look at the future of your construction company, and getting ahead of this and really making sure, if you don't have the expertise in industrial manufacturing, right? Can you develop that? Because this is going to be a huge opportunity for you. So if you do have the expertise, are you calling those old customers or new customers and making sure that you're in front of them, so that when this time comes, you're going to be the one that they're thinking about? Those, just keeping those relationships with those that may be thinking about doing this, I think is going to prove very critical to the next 5 years of how your business performs. Do you have to make any investments in equipment, in different capabilities, right? Adding people, all of those strategic decisions, I think, need to literally start tomorrow, because I think this is really going to take off and change everything that you've dealt with. I talked to a client the other day about this, who, they said, look, we're not really in that market. I don't think I can get in that market quick enough. We've got a lot of work, over in a different industry that this doesn't necessarily apply to. And I said, okay, well, do a lot of your competitors work in the manufacturing and the industrial range? And they said, yeah. I said, okay, well, that's going to impact you just there, right? More construction is good for all construction companies, in my opinion. Even if you don't get direct opportunities out of this, you are certainly going to have indirect opportunities. There may be less competition, a couple of less bidders on that sheet for the other work that you're looking. So I think you just really have to sit down and think, okay, what do I want this to be? What is my strategy going to be for these next 5 years? Because, ho-humming along and doing the same thing you've been doing, I guess it might make sense, but there are definitely things that you need to be thinking about that you need to put into place right away because of this change. I think that's everything. Keep in mind, it's not just traditional manufacturers. There are some data centers, chemical plants and refineries, agriculture are all kind of working their way in. We're waiting for a little bit more clarity on, how they're going to define all of those things. But there's, it's not just your traditional widget maker that this is going to work for. So if you've got even some connection to those industries, I think it's going to be a great opportunity.
Thanks, Mike. That's really where this is going to push things. I think there's a couple questions I want to get to here that are good questions that I think will help lead us to some better some more discussion on some of these. The one question is, can you apply this for a building that you buy? There's an original use requirement in this, and if you're buying a building and it's an existing manufacturing facility, you're not going to be able to write it off over 1 year. But let's say that it was a warehouse that's being converted to a manufacturing facility, then there's certain situations where it will qualify. But there is an original use requirement in these code sections that we used to have for the old bonus depreciation rules, but what they're going after is for new facilities to be built or expansions of facilities to be built. Another question, if we go ahead.
There's something about like a shuttered location. Like after so many years, I think it was back to 2021, if I'm remembering that offhand.
That's right. Yeah.
If you're looking at, if you do see something that you can rehab that hasn't been a manufacturing facility, which I don't know exactly how you're supposed to know that, but it hasn't been one for roughly 5 years, 4 years. That's a little bit more of a caveat that might be in there that could maybe work too.
Yeah. I think what's important is that if you're looking at doing anything like this, that we talk about it on a case-by-case basis. Like I said, anytime we get new legislation, we're going to get new regulations. So we'll be waiting and looking for those. In addition, there may be more tax legislation to come in the fall. I know Speaker Johnson had talked about that. They want to pass something not quite as big, not quite as beautiful, but they're looking at additional things. So there might be additional clarifications or easing on some of these restrictions. The next question I want to answer is regarding manufacturing equipment to newly built facilities. Will you be eligible to pick up more depreciation? And again, if you're acquiring equipment or acquiring property, it has to be from an unrelated party in order for it to qualify for bonus depreciation. So if you are simply selling property or moving property, you won't be able to pick up any additional depreciation in that regard. If you sold something to an unrelated party, that unrelated party would be able to pick up depreciation. There's also rules that are in place to prevent related parties from swapping depreciable property between one another and taking capital gain treatment. So I would be careful of anything like that. So the short answer really is no. You can't do that. And then there's one other question regarding the floor plan interest deduction. And I'm going to go back a couple slides here. The business interest deduction and the business interest limitation. If you are financing your inventory, think of a car dealership with debt, that floor plan interest is not subjected to the 30% ATI limitation. This has been expanded, and I'm glad someone brought this up because I forgot to talk about this. This has been expanded to include people that are financing trailers and camper inventory. So if someone is just buying it, a trailer or a camper to use in their business, that would be eligible for bonus depreciation, but it wouldn't have any effect on their business interest limitation. If you were a seller of cars, trailers, campers, you're financing your inventory via floor plan interest, that particular interest does not have to be subjected to the 30% limitation. So I just wanted to clear that up. Okay, let's see. Any other questions? Nope, we're clear. Good questions. Opportunity zones. This is another one that's been made permanent. And again, I was just having a meeting with a client the other day regarding they were selling their business, and we were talking about gain deferral. And, they are in an opportunity zone currently. They were talking about, well, I can sell my whole business, move to another opportunity zone, and not pay tax for 5 years, and defer that gain. And I basically told them, yeah, if you wanted to do that. The opportunity zones, again, could be a boon to construction, for development of buildings and projects in these zones. This takes place in 2027 because the old opportunity zone rules fizzle out in 2026. If you're not familiar with these, basically if you have a gain to defer, any kind of gain, stock gains, sale of your business gains, equipment sale gains, real estate gains, you can defer that gain by investing the gain portion in a qualified opportunity zone or a qualified opportunity zone business. You get to defer paying tax for 5 years, and you get a free 10% reduction in the gain. So you get a free 10% additional basis. So if you sold something right now, you wouldn't have to pay tax on it until 2030. Now, the positive then that really kicks in is if you hold that property for 10 years and then sell it, that same property, any appreciation that is going to occur within that 5-year to 10-year to whatever you hold it for period is tax-free. So if you are already in an opportunity zone, or you work with businesses that are developing opportunity zones, they're incentivized to defer gains. This is nice. It's easier than a 1031 exchange. It doesn't require the use of a qualified intermediary. It doesn't require the inability to have constructive receipt of cash. Excuse me. So this is something that, again, another permanent one that's out there to spur development, and we will see how it goes. But there's also funds that do this. You don't necessarily have to have one project in line to take advantage of this. So you could actually join a fund of opportunity zones to defer gain. And again, I think this is one that had a lot of traction for the last 5 years, and will continue to have traction moving forward.
Yeah, and again, from the construction side of things, obviously anything that helps incentivize people to build buildings and rehab buildings and make investments, all good for the industry, right? So this is just another one that this one you absolutely may be able to take advantage of, on a personal level or on a company specific level, but even in a broader global sense, this should be wonderful for the industry overall, because it incentivizes people to make investments, buy some real estate, do all the things that we want them to do to help drive business.
Yeah. All right. So I think I've all talked about positive stuff so far. But this one is a tad on you got to pay for these cuts somehow. So this one is a limitation that has been made permanent, that restricts you from deducting business losses over certain threshold amounts. and those losses are indexed. Those loss limitations are indexed for inflation. I believe right now they sit around, for married filing joint, I believe they sit around $630,000. So if you create a loss, think about all the things that we could do to create a loss this year. We have interest expense that we can deduct more liberally. We have bonus depreciation. We have our 179 depreciation. We have our 174 expenses. We can create a loss, but we can only deduct so much of it. And you can't offset all your income with the losses. So what this will do is limit the loss that you can deduct in the current year, and it's treated as sort of a pseudo NOL carrying forward into the next years. So that's something that we have to plan for, because if you create a $3 million loss on your tax return by investing in millions of dollars of equipment, you're basically creating an NOL that's going to be carrying over future years and having loss limitations. So if you have big wages, if you have big investment income, you still could end up in a situation where you could be paying some tax. But again, you're never going to lose this. It's just a timing difference. But keep in mind that we could have a situation where you are limited on the amount that you could deduct, and you can't offset your wages by business losses. They used to be able to do that. They corrected that and took that out. So if you have, that's another reason to look at your wages. We have to look at all of this stuff holistically to make sure that you're not getting into any situations where we get a surprise.
Yeah. And again, this is one, don't fret too much. This has been around for a little bit. They've tweaked it a bit.
It's been around since the Tax Cuts and Jobs Act came into play.
Right. So you may not have experienced it. It's nothing, it may not be something you're ever going to experience, but it's certainly another wrinkle, unfortunately, into helping pay for these things, as is this slide, my least favorite one.
It's just one of those things that, we want to look at it from a planning standpoint. We can't just assume that all of these benefits are going to be digested in 1 year. So again, how are we going to pay for this? They terminated a bunch of tax credits, two of which that apply to the construction industry would be the 179D deduction, which isn't so much a credit, but a non-cash deduction for energy efficient buildings, and the commercial clean vehicle credit, which was also a 30% credit on trucks, EV trucks, EV cars, things like that. They got rid of a lot of other fuel tax credits. I'm sorry, not fuel tax credits, but environmental tax credits, alternative fuel tax credits, the residential and the home improvement tax credits, which again, we saw a fair amount of usage of those, but they were, unless you were putting in a significant like solar panel project or windmill project, the credits were difficult, and you had to use certain type of labor to get the full credits, and so they took those away. Which again, if you were utilizing those, you're going to have to think about how to change some stuff. But these are the two highlighted ones that we thought were most relevant to the construction industry. 179D has been something that the construction industry has been able to use to great advantage. And that going away is something that could be an offset to some of these other benefits that we're receiving. If you're doing work for nonprofits and schools and things like that, and we're taking advantage of the 179D deduction, this is something to keep in mind regarding your future tax planning.
Yeah, and for I don't personally do a lot of home builders, but I know, our firm does. If there's any home builders on it, 45L also going away for the energy efficient home credit. If you were, from what I understand, very difficult to get things to qualify for, but If you were able to take advantage of that, that is another one that's going away. And, the 179D, unfortunately, they just expanded that one. And I've got several clients that, were able to take great advantage of that deduction. And they just expanded it 2 years ago to really multiply that deduction by 4 in certain circumstances. And it was such a huge win. And unfortunately, they're pulling that one, completely back. We do have a little bit of time that runs through, I think June 30th, 2026 for projects being in service. So we've got about another year of that still hanging around, but yeah, that one's, I wanted to leave this slide out because, it's the bummer of the slides without a doubt, but, gotta be prepared for it anyways, either way.
Yeah. So we'll talk about something that's a positive now. And that's no tax on overtime pay. This was, a campaign promise. This is a little different though than I think the perception is. I think, this isn't going to affect the employer. This is not going to affect the amount of payroll taxes that are paid. And this is not going to affect what this is going to do is affect the type of reporting that the employer has to do. There will be additional reporting and on the W-2 to show the qualified overtime pay. And this is really a deduction for the workers being able to take $12,500 of overtime pay as a above the line deduction and lowering their adjusted gross income. They're still going to pay payroll taxes on that $12,500. So FICA and Medicare. They're still going to pay tax on if their overtime wage is $50 an hour, but their regular wage is $40 an hour. The only thing that counts for this is that intermediary 10. So just because you work all of these hours of overtime, the full amount of your hourly wage is not excluded from tax. It's just the difference between your overtime rate and your regular rate. So now this is still a great deduction. It's still going to result in income taxes that are not being paid, that are going back in people's pockets, but it's not this exclusion for the employer, and it's not an exclusion of payroll taxes. I think a lot of employers thought, oh, I don't have to pay payroll taxes on the overtime too. We've had some questions about that. So that's something to keep in mind. This is really a deduction for the employees and it applies to a relief of income tax, not employment taxes, and only on the wage differential, not the full amount of the overtime pay.
Yeah, and I think one thing to keep in mind, you may have had employees ask you about this, or, I've told these guys kind of a funny story. I told a client today, my brother-in-law works at a local pipe production plant here in town. And, he came home and he said, Mike, I got to talk to you about this tax on overtime. And, I could tell you how many tax questions he's had for me. And in the 15 years I've been doing his tax return, and it's zero. So I was kind of surprised when he said that. And he said, everybody in the plant is talking all these different numbers. And there was a guy that was swearing up and down that this was going to save us 10 grand a person. So I think maybe just making sure you guys understand the dollars for this is somewhere between 1,500, maybe 2 grand. If they're way up in a bracket and it hits right around the right number, that's probably the most they're going to save on. Again, great benefit. It's $1,500 to $2,000 free dollars for them. Just make sure they understand that, this is not something that's going to save them 10 grand on the tax return. And that's that kind of stuff always scares us, because the last thing we want are people expecting, significantly different answers than they're going to end up getting at the end.
Yeah. Yeah. It's, don't go buy the beach house yet. Expecting to get that big benefit on your tax return. Mike's example, $1,500, $2,000, perfect example. which is nice. Several $100s, a month in additional tax savings. They got to wait till their tax return to get the tax savings. It's not like it's in the paycheck every week, but still a very good deduction. Let's see. We just got a question. Does the vehicle for 179 still have to be over 6,000 pounds? Yes. None of those rules have changed. Between 6,000 and 14,000 pounds, get you the 179 deduction. If you have there is an SUV limitation, excuse me. And if you're over 14,000 pounds, which is a big boy truck, we don't have any limitations. 1099 reporting, beginning in 2026, is going from $600 to $2,000. So for those of us that do 1099s, and they can be a bit of a arduous task, it's going to get easier, hopefully. Beginning in 2027, that threshold will be indexed for inflation. Hopefully we don't have a lot of inflation, so it stays around $2,000, but it's important. It's nice that it minimizes the reporting requirements for businesses. $600 is a pretty small amount of money. So jumping that up to 2,000 could be beneficial for those of us that are tired of paperwork. All right. So here's our legislative impact assessment. If you want to talk about this stuff, give us a call. We'll come out and talk to you. I know Mike is already having tons of meetings. We're getting tons of phone calls. This is all great stuff to talk about, and we'll, help you jump through all of the appropriate hoops you need to get the most bang for your buck out of this bill.
Yeah, this is the old "it depends" slide, right? Because the answer for a big group of people is it depends for most of this stuff, right? We can get, obviously, we know your companies well. For those of you that are clients on the call, we can get very specific into this stuff and let you know exactly how it affects you if you want to know a little bit more in depth.
All right. Well, we're right up against the limit of time. I think we have about 2 minutes left. So I want to thank you all for attending. Mike and Wayne, thank you guys for facilitating. If you guys have any questions, you missed it, you weren't on the call, you have follow-up questions, please feel free to contact us as much and as frequently as you would like. Wayne, is there any housekeeping that needs done?
I just want to thank everyone for joining today's webinar. We hope you are leaving with valuable insights and practical strategies to support your construction business. We appreciate your time and participation. Thank you and have a great day.
Thank you, everyone.
Thanks, everybody.